take a look at the bottom market movers by percentage change. Firstly, on the All Ords. These are the bottom three on the 200. The biggest loser, Tower, down by 8.5% today. It fell by about 28 cents, closing at $3. The second biggest loser by percentage change today, Qudeco, down by 6.4%. It fell 37 cents. And the third biggest loser by percentage change today on the 200, Macquarie Media Group, down by close to 4%. It finished up at $1.95. These are now the bottom eight. At number 4, Macquarie Countrywide, off by 3.5%. And the following stocks on your screen losing about 3%. But let's go and talk about that biggest loser today. That's Tower Australia, announcing a 10% jump in full-year underlying profit to $75.4 million. That's up from $67.9 million the previous financial year. Net profit after tax falling 32% to $46.4 million due to investment market impacts and non-cash items. The embedded value of the company rose 30% over the year to $1.16 billion, excluding the insurance line acquisition. The board of directors announcing a 17% increase in its final dividend to 5.25 cents per share, payable in January 2010. Shares down today, though. What's your take on Tower?
I ran some numbers. Obviously, you let me know that you wanted to talk about this particular company earlier today, and one of the things that strikes me about this particular business is its return on equity is relatively low. There are plenty of businesses in the funds management area that generate higher returns on equity, and there's plenty of businesses in the insurance sector that generate higher returns on equity. Now, I prefer, and it's my recommendation, that people should invest in the highest quality businesses in the sector. If you want to sleep at night, if you don't want to worry too much about, particularly if you're buying at the right price, if you want to relax at night and know that a share price fall means an opportunity and not the prospect of a permanent loss, then you want to buy the best businesses. And Tower isn't the best business in either the insurance sector or in the funds management sector. Right. It's generating a return on equity of about 11% over the next 2 or 3 years. And even though it's trading about $1.51, I think it closed today, I've got a valuation for this year of $1.36. Next year, the value goes to $1.46, and the year after it goes to $1.67. So yes, the value's going in the right way. It's not going at a great clip. You know, it's not going to win the Melbourne Cup in terms of the rate of change of its value, but its price is about right at the moment. It's not a bargain.
All right, we'll have to move on because I want to spend a bit of time on Outperform the Brokers. We are now revisiting the Outperform the Brokers segment, where we asked you for your top 3 stocks in a fantasy portfolio a few weeks ago to put them up against the brokers, and now we are going to see who came out on top. So if you remember, we did this, Gerard from Queensland,
Gerard,
the 29th of October.
But he picked all my stocks, so it's not fair.
That's funny you say that. Here are the results. So this is what Gerard picked: Macmillan Shakespeare, Monadelphius and CSL. Macmillan up by 7%, Monadelphius 3.5%, CSL. And now we'll take a look at your picks. You, of course, picked Macmillan as well. The second stock you picked was JB Hi-Fi. What a great return on that. And the Commonwealth Bank. When we average and combine all of that up, this is what we get. We'll see who comes out on top. There you go. You come out on top. 7%. The viewer 3%.
I'm not coming back on the show, mate. I mean, you're tracking my performance week to week. You shouldn't do that.
I know we shouldn't, but it's good fodder for conversation. Yeah. And we should also let viewers know anyway that the market actually rose just 3%. So the viewer did quite well to match the market. You outperformed the market anyway.
Well, my job is to outperform. You know,
absolutely.
I'm not going to bother if I can't do that.
Can we talk about Macmillan?
Sure.
Up by 7%. Do you still like it?
Yes.
Right.
Yeah, very much. The price has actually dropped from its recent highs, and you can see that in the chart. But its value is about the recent highs. That's what I think it's worth. So any further declines represents an opportunity.
JB Hi-Fi, what a performance, not just now, but over the year, really going against what a number of brokers thought would happen. What's your take on JB right now?
I think I had one sitting next to me who said I was wrong, and he said it's expensive. It's got the highest PE ratio of the retail sector. People shouldn't focus on PE ratios. They do lead you astray. I don't pay any attention to them at all. You can see there that I've been saying consistently on this show for the year that it was cheap. I still think in 2 years' time, the business, its value, I don't know what the price is going to do, so I'm not predicting the price, but the value is over $34 in 2 years' time. Its value next year is about $26 or $27, and then, of course, the year after, around $35. That's what I think it's worth. If if it hits all of its targets and everything that they said in their presentation for the full year results, if it does all that, that's how much it's worth. If the share price drops, that presents an opportunity, and you shouldn't fear that. You should actually look forward to it as a net buyer of that company.
And the third one you picked there, the Commonwealth Bank, it's coming at a time where there seems to be a switch out of the banking sector into resources. Still, the Commonwealth Bank up by about 2%. You know, do you still like this stock in the banks?
Well, I think, and I remember this distinctly when we talked about the CBA back on October 29. I said I wouldn't be buying it at these prices. I think it's about right. It's not expensive, but it's on its value for a year and a half to 2 years out. And what we've seen really is a consolidation in the price of that particular stock. I just happen to be lucky that I'm on the show today, you know, and it's showing a return.
Exactly.
But I do think it's going to be the best of the banks, and I've said that before, and that remains the case. Its return on equity is going to be double the other banks over the next 2 years. It's the star performer. It's going to be head and shoulders above in terms of economic performance compared to the other banks.
Of course, we should remind viewers, I mean, this is just a very short term, it's just interesting conversation in terms of comparison.
No, I agree.
But, you know, as most investment experts say, you should be investing for the longer term.
I was waiting for a girl to come out with some flowers and maybe some champagne or something.
Maybe on commercial television. This is Virgin Blue. You know, you either like airlines or you really don't like them. Which camp are you in?
Are you inviting me? Is that a lure? I've got... If I can mention my email address, I've written a paper on which was published in some university accounting textbooks about airlines and why basically you should never own them.
Okay.
So if people want to email me at roger@rogermontgomery.com, I'll flick them a note on exactly how to read the annual reports of an airline and what the real profit is. Virgin Blue is no different. It listed back in, I think it was 2003, I think that's about the time, and it listed around $2 or $2.50, and I remember at that time I was on a radio program and someone said, look, you know, it's going up, there seems to be a lot of enthusiasm about this new company, what do you think? And I said, it's an airline and ultimately it will perform just like all the other airlines, and precisely that has happened. So the share price today, 52 cents compared to 6 years ago when it listed at near $2. The returns for Qantas are about the same. You know, it's trading a few cents lower than where it was a decade ago. These businesses are really tough. They're competitive. You can fly to Melbourne for cheaper from Sydney for less than it would cost to ride a bike down there in tubes and food and so accommodation and yet it's an extraordinarily expensive business to run because your equipment is so expensive and that equipment keeps getting more expensive. So a capital intensive business like an airline, when there's inflation, any type of inflation, and the cost of planes keeps going up to purchase them, then what you're going to find is you're always going to be behind the eight ball. You're always going to have to pass the hat around, and every time the hat comes around full, well, you've staved off liquidation or bankruptcy, and when the hat comes back empty, Chapter 11 bankruptcy, which is what happens to US airlines. I don't like these particular businesses. The return on equity for Virgin over the next 3 years is expected to be 4%, 11% and 16%, but those profit figures are boosted by the fact that there's an item in the annual report and the profit and loss statement called depreciation, which doesn't properly take into account the replacement cost of planes. So if you remove that item and put in something called provision for replacement cost of aircraft, you'd find that the profit figure would be a negative number. There'd be no profit, and then there'd be no dividends that could be paid. So these businesses actually probably don't make any money. I've got a valuation for this company of about 40 cents, 50 cents. It's trading at about that. There's nothing in it, but you know, it's all very well to have a business that's trading at a discount to what it's worth. You still want to buy good businesses, and airlines are very, very tough businesses.